So the October 15th tax filing extension deadline is finally passed, and 2022, the tax year, is now in the rearview mirror. So what should you be doing now? The simple answer is you should be doing tax planning. Now, you really should be doing tax planning throughout the year. You should have an annual and a multi-year planning process that you're updating constantly, both for income tax, estate and gift tax, and any other taxes that may be applicable to you as you move forward in your business. So it's important really to get a baseline for where you are for 2023. The best way to do this is to have a projection done of your 2023 tax liability. It's difficult to plan if you don't know where you're starting from. And for doing the 2023 estimate, you want to get all of your income sources, that's your W-2s if you have them, your business income, your investment income, gains and losses from sales of securities, all of your income items and loss items if you have them, rental real estate, rental income, rental losses, all of that gathered up. Work with your CPA to come up with an actual projection of your 2023 tax liability. Now, of course, you'll also want to consider your deductions and your mortgage interest, real estate taxes, charitable contributions, whatever deductions you have, and then start with that and say, okay, here's my base case. And if your base case is a significant tax liability, then you start to think about what can I do to change that tax liability, to minimize that tax liability this year, and then also start to look forward to other future years. The reason I say that it's important to look for multiple years is that you may want to do things, for example, like defer income from 2023 into 2024. And some people have the ability to do that. Now, you can do that, for example, with investments. If you, for example, have a significant capital gain in Apple stock and you're wondering if you should sell now or sell in early 2024, you may want to consider moving that gain to 24. Now, you also have the market risk that the stock could go down by the time you end up selling it. So that is a factor that you have to consider. And also, if you have a business, you also consider the timing of certain deductions. For example, are you going to buy a new car? Are you going to buy a new piece of equipment for this year? Should you move something into this year that you were planning to do next year? Do you have the cash to do that? And this goes into your business budgeting, your business accounting. You need to have really good up-to-date numbers to see where you are from a business income standpoint to make sure you consider the proper things to do at your business as well. And also in your business, make sure that you're considering credits, and like the research and development credit if that's applicable, the jobs tax credit if that's applicable, other significant deductions like retirement plans, really everything that you can think of and your CPA can think of to get your tax liability as low as possible. So the other thing to consider is with regard to capital gain income. You may have, for example, that significant Apple capital gain that I spoke about earlier. You may also have a stock that has not done well and you're sitting on a significant loss. If you sell the Apple stock, you may also want to sell the stock that has the capital loss in it, because that capital loss will offset the income, the capital gain income from your Apple stock. So important to consider not only what's happened, but what could happen and what you could make happen before the end of 2023. So now you also want to consider many times your estate and gift tax situation. So this is just the tip of the iceberg, really, because as you can tell, there are a lot of touch points, a lot of information, a lot of thought, a lot of number crunching and planning that has to go into developing a really good tax plan. Most CPAs don't have the time or the capacity to really be doing this with their clients, and they end up doing a rudimentary calculation of what the tax for 23 is estimated to be, and they check to make sure that you have enough withholding and you have enough estimated tax payments so that you're not subject to any underpayment penalties. What you really want to do is work with a CPA who's not only focused on doing your year-end tax return work and coming up with some projections of your tax liability. You want someone who's focused on tax planning and helping you minimize the amount of tax that you pay both today and going forward, so you're able to maximize your income and your generational wealth. So if you'd like to have a short conversation about whether tax planning is right for you, put a 15-minute call on my calendar and we can talk through where you are and what your goals are for the future.